So good afternoon, gentlemen. We have fish eyes and swimming the market, two of our best members here at Clueless 8 Trading. Today is Super Bowl Sunday, February 5th, 2017. We're going to quickly go through a bunch of stuff here regarding markets, regarding some individual stocks, regarding the overview of what I think is might be coming up over the next couple of weeks, going into the end of February, and we'll move from there. Questions are always encouraged, and I'm certainly here to answer them. So let's start off by taking a broad bird's eye view of what's happening with the markets. Here we have the election lows right there. You see that, and then the subsequent waves of movement that have characterized the market over the last. It seems like years, but it's only been a few months since the market really started to make that impulse move higher since November. We got December, January, February. Wow, it hasn't even been full 3 months. So this is pretty incredible what's going on. Let me just put it this way. What you're seeing in front of you looks like just a very simple, okay, that's the market, that's what it does. Well, we all know, and certainly you guys know better than I do, is that it's never easy. Because these impulse moves happen very, very suddenly, and unless somebody's tracking many different facets of the technical side of the market, such as I do, on whether or not it's a multiple bottom, whether there's a pivot where the market keeps on bouncing off, which was right here. 1 second, let me just try to. Okay, let me just actually put the SPX there for conversational purposes. Okay, so that's better. And let's take out all the lines for now. Let's remove all the lines so we can get a clear picture. Good, and then we'll draw things on it. So bottom line is, when you look at this picture here, just for somebody who's a novice in the trading business, or somebody who's not a trader, they'll look at it and say, hey, the market's on, the market's just going higher. I mean, what's the big deal? And guess what? They're right. The market's going higher. And there is really, when you look back at it, there is no big deal. But as traders who are looking at the market on an intraday, on an intra-week, on an intra-month basis, it's a big deal, because we don't know when these things are going to happen. But as we do these type of sessions, as we sit here and analyze where we have come from, which was the lows, back on the overnight lows, which are not reflected on this chart, obviously, because it's S&P 500. But let's say an actual low of 2083 on the 4th, and then then the subsequent move here. The bottom line is, it's pretty clear that the market's going higher. Now, saying all that, we have had severe volatility. There's no question about it. And the next chart that we'll basically quickly cover, just to remind ourselves how we need to adapt to this new paradigm, which has been not new, it's been going on for a couple of years, of this algo HFT volatility, is the fact that when we look at the 1-hour charts, it's one heck of a volatile market. There's no question about it. Nobody in their right mind, including me, I expected the market to go higher, but I didn't expect the markets to go up almost 200 points on Friday. And it wasn't because of the jobs report. The markets have a predestined number it wants to go to. So they'll find any excuse that's out there to do what they need to do. Yes, I do admit that there's no major negative out there. But then at the same time, with companies like Amazon dropping 4%, it's really was an Amazon issue, to be honest with you. And it really wasn't an issue. They just didn't churn out as much profits as they should, based on their biggest moneymaker, which is the Amazon Web Services. Amazon Web Services didn't meet the high end of the criteria that a lot of analysts had put out there. So a 4% correction on Amazon, it simply came back to where it was a few weeks ago, to be honest with you. So saying all that, you wouldn't expect the market to have a 200-point up day on a day like Friday, but then most of it was driven primarily not by technology, it was driven primarily by banks and financials. That's why good old Goldman Sachs went up 10 frigging bucks. And that's it. You know, between Goldman and Apple being up a little bit, that did the job. But it was primarily regional banks and financials which drove the market, period. And so that's basically what the market's doing, sector by sector, and you just don't know when it's going to do what it needs to do. So let's draw a couple of very simple basic trend lines here to figure out where we're going. So there's one, because this was find the optimal point here. I would say that this is one. Draw it from this level again. In fact, I would start from here. That was a trend line the market was following till it broke. One second. That's the uber bullish version of the upper trend line, upper channel. And every time I draw like super bullish versions of a chart, at some point or another it happens, which is pretty scary. Because I don't expect, I don't personally don't want to subscribe to the theory that I'm like losing my head and I'm super bullish. But then every single time that I've drawn these charts, especially when I've been working with you guys better know better than I do, it's happened. And it's frustrating because I don't want runaway bull markets. I want markets which are basically where we have chances to get in. And that reminds me of something that I wanted to, mention to everyone, especially you guys, is runaway markets are no good. Not because I'm sitting there, doing that, all the big talk about, oh, valuations are crazy, everyone's super happy. We know that that's all garbage, because if you look at it from a valuation standpoint in the market, on an inflation-adjusted basis, the Dow should be, just so you understand, the Dow should be right now close to. Are you there?
We're here.
Okay, no problem. Tom, you there?
I'm here.
Oh, okay. On an inflation-adjusted basis, okay? On a discounted cash flow inflation-adjusted basis, the Dow Jones actually should be some north of 22,000. Somebody says, oh, how is that possible? Because when we look at the Dow, we're just looking at numerical numbers, not taking into account that it's not adjusted for inflation. That's something which is sort of, that's sort of getting really wonky about the economics of the markets. So from that standpoint, it's not overvalued. From a multiple standpoint, they said that S&P is trading at a multiple right now of north of 19, PE multiple. Okay, understood. Have you taken into account the current interest rate environment? So when you adjust it for the actual interest rate environment, the depressed rates, it is still very depressed rates. We know that. Okay, let's face facts here. Compared to the last 20 years, compared to the last 10 years. Based on that, the S&P 500 should be trading at 2,400. So when people talk about just throw out numbers, oh, look at that, S&P 500 is now hitting 2,300. It's like way out of control, things like that. It is not way out of control. It is basically doing what it's doing, but more importantly, on a not risk adjusted, on a price to multiple adjusted basis, S&P 500 should actually be trading around 2,400, and you're talking about that's another 600 points from here. So those type of when we compare in math, for example. Is between two variables. You have to between two what do you call it, real numbers. You have to take into account what the variables are within those, or two models. We have to know what those variables are within the models. If we don't have the variables, such as interest rate, such as inflation adjusted numbers, such as the current, and those are the two main things. Then obviously you can't make a apples to apples comparison. You're making apples to oranges comparison. And that's pretty much what the media does. That's what pretty much a lot of Wall Street guys do. But at the same time, the fact remains that this is where we are. So let's take a look at what I just did in front of you guys and look at it from my vantage point and my way of interpreting the markets. And I think I'll be right. So here are four major channels. Here are four major channels. This channel here, somebody says, well, there's no starting point here. Well, there was a starting point because this is where the markets went. This is where the markets went the night of the elections. So we did satisfy that particular starting point, or and the number that's required in pure, so-called pure technical analysis. You have to always have a contact point between the lines that you're drawing. So this contact point was met because we did go down around this level. Good, perfect. So in that case, these channels, at least from a drawing standpoint, have satisfied the criteria needed for proper technical analysis. So when you look at this here, going back to November, while this, believe it or not, this is the type of chart, guys, that we used to look at back in the days, and this would be years, not 3 months. This would be years. This would be something like a 2-year chart of the market. Back in the days, meaning back in the 90s, late 90s, early 2000s. This would be a 2-year chart, except now it's compressed within 3 months. Therein lies my constant reminder to people that this is a algo HFT driven world where the scale of time is much, much faster and minimized. It's like cosmic time, right? What's 1 year in cosmic time is 100 million years in Earth time, right? You understand what I said? Yeah, exactly. So okay. So this is what's happening with the markets, is that what was normal time, which was a year, 6-month cycles and 18-month cycles, now being compressed within 3 months, 3 days, and in some cases, hours. And this is where we are. So once we understand that, we're good. So let's look at these channels here. So this is not a 2-year channel, so I'm going to get this out so we don't get confused, and we start here. This criteria was met. This was met. I kept on talking about the fact that we would have that, and again, that's on the algo HFT side. I constantly kept on showing, and I will tell you, at some point or another, definitely go through every single chart. Go through, glance at it, just remind yourself, because those are been so precise, the ones that I've printed over the last 10 days or so, guiding people through this morass of volatility that we went through. It's mind-boggling. One of my charts talked about the fact that we were at a double bottom. We were at a double bottom dragon bullish formation. Boy, was that a call or what? Not only was it a double bottom, in fact, it was actually a triple bottom when you take in the intraday dip back towards the 2260 level. The dragon bullish pattern played out like nobody's business. It was just a fire-breathing dragon. It was just like, boom, gone. And no wonder the S&P calls literally exploded from pennies up into the high single digits. Problem is that they're happening so fast that I'm catching the moves in the middle, but I'm not holding. But I'm not. I'm not being. I don't have the original position right at the end of the point where we say, "Oh my God, it actually went there." But that's okay. At least we're catching a bulk of it. That's okay. So let me go back to this picture here. So right now this is the level. This is a major support level here. And now that it's been this is a 2258 on the S&P and 2231. And then since the November elections, this was the breakout level, 2214. Seems like, wow, such a long time ago. It's such a far away point. It's really not, because we are at It's still, yeah, you're talking about 22.14, and where we are right now, we're talking about 80 points, 83 points. That's a 500-point drop in the market from here to where things broke out. So we've talked about this many, many times about the 400-500-point drop in the market, which I think will happen. But looking at the channels, it looks like it's not gonna. Anything can happen. There could be a big event overseas. There could be a domestic political event here on the corporate front or so, which could derail markets quite a bit. So all that is, all that is in my modeling, and so I'm not like, saying I'm not kind of archiving that scenario. So here we are. Sorry about the lines in red, but anyway. So bottom line is that at this juncture, this is the level that the market basically refused to break since the beginning of the year. Since the beginning of the year, the level that the market actually refused to break on the way lower end is 22.34. I'm concentrating on what the market is doing right now. So on this front, the level that the market consistently bounced off is 22.60. It's actually 22.65. Let's call it 22. Here it shows as 22.67. So keep that on your head, the 22.65 number, because markets are very frisky, right? So the minute it breaks a certain level, immediately the sell programs come in. We don't see the pivots on this particular screen, but the pivots generally seem to vacillate somewhere around the 22.60 level. So the minute the 22.60 breaks, the markets fall, kept on recapturing it. That's why we kept on staying higher. And then, but if it stays below that for more than 3 days, you're going to see a waterfall decline further into lower levels that are projected here. Saying all that, at this point on the daily, we are about to basically engage the upper end of test the highs, which was the, one second. The highs in the S&P, I believe, were, don't have that directly in front of me, but we can see that here. Look on the left-hand side here, high. This was the day the market hit a high, which was the 26th. The high was 23.01, rounding off the decimals, okay? So we are basically at this point going to engage that based on pure technical forecasting. On the way up there, and it's just around the corner. It's just around the corner, right here. So once we break that, it's pretty logical what we see in front of us. Come on. Trying to be a little bit precise. Okay. So once we break this, change this to blue. Perfect. Once we break this, then we have the channel number 2 engaged, and that is roughly around 23.17. That's what I'm projecting where the markets will go pretty much by fill in the blanks. When do you think we're going to get to 23.17? What's a big day coming up? What's a big day coming up within the next week? Not next week, by the 3rd week of February. I've already given it away.
On the 15th?
Huh? No, what?
Mid-month?
Yeah, right around mid-month. What's the big sort of social event that comes up? Valentine's Day. Okay. So Valentine's Day is February 14th. So by February 14th or so, my projection, and again, remember what I always said, and you guys know better than anyone, okay? Never short the market before a major holiday, shopping holiday, whatever you call it. Don't short the market before Super Bowl, okay? Don't short the market hard. I mean, before Valentine's, period. It's the way it works. We've been seeing it over a year. So bottom line is, I believe the upper end of this channel here, channel number 2 actually, is that 2320 level or so, which will be engaged by Valentine's Day weekend. And that, looking at my quick calendar here, Valentine's Day is Tuesday. So basically the weekend of this is going to be the week, this is the weekend prior to Valentine's Day weekend. So we should, by the 10th of this month or so, by the 10th of this month, which is this week, end of this week, and keep this in the back of your head as you're playing the SPX, you are going to, in my opinion, high probability, both technically and the count on a calendar, on a day count level, we're going to hit around 2320. So we're talking about SPX closed at, what did SPX close at? It closed at 2297. So we got 23 more points. No big deal. 23 points times 6. You're talking about 120 points or so. So that's what I'm looking on the max side and that satisfies what I'm looking at from a technical standpoint on the channel view. All right, so just keep that in mind. So that 20-point S&P move is, in my opinion, and again, it's not going to be a straight line. It's going to zigzag around during the day, but catch that nice move. Even if we dip back a little bit too, you are going to be well rewarded, and that's pretty clear here in my book. I mean, here in my on my screen. Now, saying all that, the Dow Jones is at 20,071. A while ago, I'm talking about last year, I projected the Dow Jones Industrial Average to peak around somewhere around 2150 to 20,200. It was one of these sessions where we were talking about projecting out the Dow and drawing the lines and stuff. So my opinion, the Dow Jones 20,200 or so is going to be a short-term major top in the market. Just keep that in mind. And so we're not too far away from that. Now we can overshoot. It can overshoot a little bit, but that's the level that I'm looking at. 20,250, 20,200 is where we go. And this is basically validating that because this is a very clean chart, cutting out a lot of the noise, and this is where we are. So end of this week, 2320 or so, and that's it. Now, upper channels. These upper channels, we'll leave it for later. I mean, we'll see how the market reacts to hitting this, because every time that we hit a, one of the channels, we tend to move sideways for a bit before we break out again, and that's normal procedure. So if that's the case, if we hit here, it's not like it's immediately going to come down, but at the same time, at that point, the previous high of 2300 or so becomes, did we say 2300? What was the high on the market? Yeah, 2301 becomes support. Same old stuff. Same old stuff. So this becomes support. So is it not possible that we move sideways and kind of hug the upper end of this channel, or maybe come down and come to and retest this? All that will happen. No question about it. But at least we will remain, as long as we remain within this channel, that means the market's uptrending, period. Once we start breaking it ferociously, there's a trend change. And of course, if we break below the 22, below the 2230, what did we say this number was? Because that's a very pivotal number here. 2230, yes. Then we're talking about a trend change. A trend change doesn't mean we're just going to go back and test this this whole pre-election, thing. Well, I don't think so. Unless something really dramatically goes wrong, they can't pass the corporate tax reform whatsoever. All kinds of stuff. I'm not talking about the political stuff with the refugees and all that. All that will be managed. But I'm talking about the economic stuff, and that stuff I believe is what is the biggest risk to the markets. And if certain things don't work, then this is a very high probability. But that's asking, that's a black swan type of event. In the meantime, this is where we are. So are we clear about this chart? What we're doing? Okay, good. And now, big picture out. Let's talk about the reality. Now, Reality are the E-minis. We know that. So looking at this here, this shaded area was what I had put as, there you go. This is the chart I've been trading all week, all day. Intense volatility. Isn't it beautiful that we do these sessions and we look back and you're like, wow, that's a frigging dragon bullish. I mean, we should have known that. Yeah, right, right? But at least I projected because it just seems so simple. Like, wow, look at that. These are very convoluted, complex structures, but there's a pattern. And I know you see it, and I know Tom sees it, and and I'm sure there's a bunch of members who see it. Many don't because they're fixated on the daily volatility and not on looking back at it a little bit and saying, okay, this is what we're. I'm okay. You know, I'm nervous because the market's doing a sort of free fall dive at 10 a.m. for no reason. But at least you keep this picture behind you. So the 1 hour is key. Major support here. You see that 2262 on the E-minis, and this is where we are. This is a minor bull flag. It can slip a little bit. Whichever the case, you can clearly see here using old-fashioned crayons that this is like a dragon bullish. I mean, on a dragon bullish. There's dragon bullish here. There's dragon bullish or W formation. This is actually inverse head and shoulder with the left shoulder here, right shoulder here. And then the whole thing is a massive frigging dragon bullish. So whichever the case, regardless of the news flow, regardless of the gyrations during the day, one way or the other, they are going to take this here. And 2300 translates into that 2307, 2310 type of number that we saw on the S&P 500. So this will be, in my opinion, is a high probability move and an overshoot because it just doesn't go there and immediately fall. There are resistances along the way, and I keep on posting that so you guys can see that on your chart. But this is a pretty defined chart as to what's going on. Okay? Pretty defined chart. Now, saying all that, if we look at this on the daily, we can see here something happening underneath the surface, similar to stochastics. As you know, it's called the Dynamic Momentum Indicator, or DMI, Dynamic Momentum Index, another fancy name. You can see here that we are pretty much, and that's why I had this, we're pretty much good to go here. Not bad, not bad, okay? This is, and the way I would do it is not this line. I would basically do this. I would actually do it like this. There you go. And I would do another line here like that. Okay, so whichever the case, this was the lows here, the 2230, which I consider to be a very pivotal critical support level, and the breakout level here at 2213. But once it breaks 2230, it's going to drop very quickly to test this and possibly, you know, come under here beginning of December, whichever the case. Those, you know, I'm not projecting that far yet. So this is where we are. So looking at the structure of the DMI, and the stochastics look pretty much the same, this is where we are, and pretty okay. It's maintaining the uptrend. It needs to go over this line here, over the 70 level on the DMI, similar to the 70 on the relative strength index, the RSI, and this is where we are. Now looking at this, what does this pattern remind you of? Patterns are very important these days, as we know. What does this pattern remind you of? Sorry, moving around the cursor too much. What is this pattern?
It's an ascending triangle.
Thank you, sir. Thank you. Exactly. It's a definitive ascending triangle. Okay? You're absolutely correct. What do ascending triangles do? We've seen it happen repeatedly, one after another, and that's why I like to always remind me of the basics. Because what happens sometimes, without deviating too much from what we're discussing here, is that when just the way I say analysis paralysis, well, I go through some micro analysis paralysis too, because I'm looking too much on like, okay, you know, this is what it is, and I'm not really missing the bigger picture, but I'm losing track of the bigger picture on that moment, and maybe taking our trades a little bit too early or so. So we need to basically focus on the bigger picture, then concentrate on the smaller picture, and I'm guilty of that too. We're all guilty of it. I'm guilty of it, you know. But this is clearly telling me that this is a forget dragon bullish. I mean ascending triangle, an ascending triangle, breaks out. We have seen that happen repeatedly. Now, whether it breaks out or not, it will at least touch the upper end of the scale, and that's good enough for a decent, for another 10 points or so. We closed at 92, so yeah, another 8 points. But it looks very likely this is going to happen. Overshoot. That overshoot brings us to a round number of 2310, or we can look at it as a cup and handle number, gentlemen, of 2260. Let's call it 2260. The depth of the cup here is 2300, correct? That's 40 points. You guys are with me on this, right?
Yes, yeah.
Okay, good.
Yes.
So once it hits there, very possible that that we create a minor handle, which brings us back into the zone here. Whichever the case, it's a 40-point depth. Cups add 40 points to 2300. We could be topping and creating a major top in the market at 2340. Just based on pure cup and handle depth analysis and adding to the breakout. And we have seen it happen a lot. We know it doesn't happen in a straight line, but that's where it lands up. So if somebody asked me, what do you think the max move on the market would be? I say 2340. And that's not asking for the moon. We are at 2290. That's 50 points from here. So 50 points on the S&P, 50 on the SPX is roughly 300 on the Dow. That brings us up to the 20,300 level, and I think that's good enough for now to take a break and do some nice shorting. And of course, they don't make shorting easier either. But that could be a tradable top. In other words, where the market pauses and sort of moves sideways, breaks down a little bit, but doesn't break that for at least the next month or two. So that's where we're going with that. So multiple patterns here, descending from a point of pattern symmetry. Just keep this in mind from a technical analysis standpoint. Certain patterns have more weightings or priority during certain times of the market. So looking at this picture here, the first one that has the highest weighting or priority is, like Jim pointed out, the ascending triangle. The second one, you can be looking at it from a cup standpoint, so that the cup is the second weighting on this model. Okay, the range that the market is trading in is also a major factor. It's a big trading range, right? It's a trading range of 40 points. And 40 points on the trading range is roughly 200 to 240 points on the Dow. It doesn't shatter the world. Makes it feel like the world's ending at the time that it's going on, but that's the reality of machines. We have a 40-point trading range going forward for now, till we break out. Fair enough? Till we break out, we are stuck in this wide trading range, which is a weekly trading range, by the way. Even though it's a daily chart, it's actually a weekly trading range, 1 week. See, week. It's a weekly trading range we're trading in. So putting things in perspective, we are in a 200, 240 point trading range with a fat bullish. And this shaded area was drawn, if you recall, on one of my charts prior to jobs, saying that would be the trading range after the jobs report. And of course, it didn't satisfy the downside because it went a little bit lower, and then it just took off. That is one of the fattest bullish engulfing candles that we have noticed since here. I'm just looking for the size of the candle where we can pinpoint them off a inflection level. Somebody might say, oh, there was a big fat bullish candle here, but that doesn't seem to, it doesn't match the stage that we're in. We're coming off a major hammer reversal. You see that? That's actually a hammer / doji reversal, indecision. Because I think for once the market really didn't know what the jobs number was going to be. Okay, so there was indecision, and it wasn't just the job numbers. There's other stuff going on. So bottom line is, it's coming off a powerful doji. That means indecision. Now the market has decided, and that's why this is the fat decision candle, the bullish engulfing. So this reminds me of this, And generally happens when we get this type of thing here, you just don't automatically just give everything back. Sure can happen, but that's a low probability event. So if we create another candle, then we satisfy the parameters that we talked about on the upside. They're clear with you guys?
Yes.
Perfect. So playing the indices, I think, would be a very smart way of doing things, and leaving some of the stocks aside. But we're playing some stocks too. But whichever the case, this is it. Now, in order for this to happen, it's actually become quite simple. What needs to move higher? Banks and financials and good old Goldman Daddy Sachs. So Goldman Sachs most probably will hit $250, which is just around the corner, in order for this to happen. Because 10 points, every move on Goldman is roughly 10 to 12 points on the Dow. Goldman alone can't just take the Dow higher, but you know what? If Goldman goes up 10 points multiplied by 10 to 12, that's 120 points on the Dow right there alone. And of course, other of the Dow components have to cooperate. So looking at this here, this reminds me of this, and this is one heck of a dragon bullish. I mean, what dragon bullish? Bullish engulfing candle, and one shouldn't just mess around with it. Now, it doesn't mean we won't open down a little bit on Monday, like it did here, but it's a question of not where we open down. It's where we land up. Now, when does this candle become dangerous? By the time the candle becomes dangerous, somebody will tell me, well, when it's a bearish engulfing and there's a big fat red candle that basically encompasses the body of this bullish engulfing and then closes lower than that. Well, we already know that. But by the time we see that, it's too late to short. Correct? By the time we see that, too late to short. So where's the predictive part of it? The predictive part of it is that, one second, is that if we lose half this body, so let's arrive at a number here. If we lose, let's say 22, if we lose 2280, write it down somewhere, 2280. Just looking at it visually, that's about half the body of the candle, right? So if we lose half the body of the candle in the form of a red bearish engulfing, then the chances of a possible retest of the 2270, and when you're playing SPX, these things matter. These things matter a lot, right? We know that. So the test of this and a test of 260, the probability rises. If we lose, it's basically like a 50% Fibonacci retracement, except it's from the top end. So if we lose that 50%, then the next levels come into play. So there is bottom line is that when we look at the chart at the end of the day on Monday, and we see that it's closing below that, it could be negative. It also might not be negative, because if it stays within the body of the candle, what's known as an inside day, that means the market still has juice to go higher. You guys understand what an inside day is, right?
Yes.
Yeah, just basic candle, and basically the next day's candle is within the day. So that's an inside day. So inside days have been spotted, for example, here, right? I mean, this was, definitely it scared the living daylights after moving out here. But what did the inside day signify? That we still had room to move higher. But once you see something like that, that means some big boys have sold a bunch of stuff, and the market will have trouble going up. And that's exactly what it did here during the middle of December. See that? This is pure candlestick dynamics. So once you get a day like this, it's tough to reverse it unless you have another fat bullish engulfing to take out the gravitational force of whatever this sell program was. And that's what it did. Consolidation channel, which I kept on showing, broke out of that, tested the consolidation channel, the lower end of it repeatedly, broke out of that, and we haven't broken out of this big consolidation, which is a 240-point move on the Dow. So that is the picture of playing the SPX. Now, the intraday stuff, just have to track my charts, have to look at your ES and do it. Intraday, Yes, we're overbought, but things move so fast. Remember one thing about overbought, oversold conditions. In uptrending markets where they say, wow, shorting's so difficult. Well, it is difficult because the resets happen very quickly, and then from midair, the stows can turn and go higher. So it's not worth spending time trying to figure out, oh, is it going to hit a 4-point level? Is it going to go lower, higher? It doesn't make any sense. We just have to remember that if we break below, and of course, during the day, I have a better shot of really looking at it based on the E-minis start trading today after 6 p.m. I have a better chance to look at it. But generally speaking, like, you know, if you're breaking the pattern by breaking below here, or if it's going to fall below 2285, 2280, only you can see it while it's going on. And of course, I keep on posting charts during the day, but it's not possible to do it on a minute by minute basis. The other thing you might want to do, which I do a lot, is I draw a downtrend line. That downtrend line intersects at 2279. You can do this with anything. For the indices, it works the best. So once it breaks the downtrend line, then the next, then the supports come into play. So if the market breaks this with a fat red candle, the 2278 level on the E-minis, then the chances are that we're going to test this, that we're going to retest this 2260, 2265 level again. That's decent money if you're playing with a couple of puts, right? You're with me, guys, on that?
Yes.
Yeah.
Absolutely.
And that's it. And that's real trading. And it pays. You know, make a decent amount. You don't need to sit there and like forecast like, oh, what's going to happen, this and that. I draw this, 1 second. I'm going to move back a little bit and show the previous. Yeah, so this was the previous channel that was just for people not inclined towards my type of analysis, you know, like, oh, the market, you know, it's like, you know, same old term, it doesn't know what to do, it's going to crash, all that stuff. But this is the trading range that we were traveling in. It's really simple when you look at it. This was the trading range that we were traveling in for, oh, let me try to minimize this. Come on, cooperate. There, okay. So this was the trading range we were traveling in, which was 2250. I'm sorry, 2252. Call it 2250, and here 2275. More so around 22. Yeah, right there, 2270, and that's what we broke out of on Friday. So once we entered this range again, maybe we just keep on doing this for a while. I don't know. But I'm basically saying that that was your trading range. We broke out of it. Now we should meet the endpoint up here somewhere and then decide whether or not we're going to crash and burn and come back, crash and burn meaning from a technical level, back into this zone, because this zone was the longest zone overall that we've been traveling in for traders. There. So that's your point. You don't want to cross the red line here. That's it. You cross the red line here, then you're stuck in limbo on this band, which is 2265, 2275, 10-point bands. That's it. That's your E-mini part of it, because that will help you decide how you want to play the SPXs and stuff. But that's the chart. You go back a couple of Sundays. It's 1, 2, 3, 4. Go back a month. 5th Sunday. Okay. Yeah. Go back to on your screens. You can go back to, what's the date up there? Beginning of January 8th, right? January 8th, right there. And that's how you should set up your charts on your end. Fair enough? Okay.
They are.
Yes.
Okay, now let's take a look at Goldman. One thing I love about the Goldman things are that the calls are cheap. They're not cheap. Yeah, they're cheap. Compared to the crazy stuff on Amazon and all that garbage, I mean, they're cheap. They're $2, maximum maybe $3, and the stock moves because it's become a trading specialty. And now we're going to quickly look at it, because if you're going to play stocks, I would say stick to this. It's not crazy. If it pulls back, you want to cost average down. It's not going to kill you. You don't have to pay an arm and a leg like a Priceline or some of the other big ones. So from a standpoint of premium, they're very affordable. And I like that. Because every stock, like I said from a long time ago to you guys, has a different characteristic. Options have a different characteristic. Some are affordable, some are not. Some are more elastic than others. In other words, you know, the correlation between the stock price and the options prices are very favorable. Goldman moves 15 cents, the options move. The biotechs, they kill me all the time. Not monetarily, but just the fact that Clovis has been a fantastic winner for months now. I mean, for weeks. The frigging thing is up $25 from my original alerts, which was 40 to 42. The options are the most frustrating things ever because they move. Stocks up $4. The frigging options are up 80 cents. Like what? You know, on a $4
Yeah.
move on Tesla, I would be doing jumping jack flips. You know what I'm saying? Which we do all the time, right? Like $4 on Tesla. Like, come on, options you bought at $1.60 are at $4. So these things, it all the characteristic options. So Goldman falls within a decent criteria of not being heavily, not being uber volatile, but at the same time very reasonable. So here's Goldman's chart. It looks very likely, given the shape of this here, which is, tell me what it is.
Dragon bullish.
No, yeah, that's a big dragon bullish. I mean, that's, yeah, it's a big dragon bullish within a trading range. What is this?
The flag over the breakout.
There you go. It's a bull flag. So basically, bull flag. So if we respect technicals, which we all like to do, but even guys like me, we're like, oh yeah, I'm a technical guy, this and that. You know, when the market starts getting frisky, we're always looking to see how quickly we can take down the profits. This is discipline, and that discipline basically tells us that this one is going to head towards 248. Now, it's not going to be like a straight line. I know that's kind of a straight line. The word itself should be an oxymoron in technical analysis. There's nothing called a straight line. It zigzags its way up, but that's where we are. We have a we have a cup, which was forming, which was trying to create a handle. Then the handle broke because whoever was drinking this lovely tea with the queen didn't know how to hold a cup. Okay? Just kidding. And then we created that big volatility channel, dragon bullish. This was my trigger the other day, and I said this stock is going higher, and that's why I kept on buying the lottos. Okay, this right there. That was one heck of a reversal hammer that I showed on the charts, and I said, you know, this told me. And even after the reversal hammer, the stock basically did a descending, you know, kind of a descending triangle, falling wedge type of thing, confusing the crap out of everybody. And then see you later. So this was the trigger point, as in determining what would happen right there. This obviously looked a lot more pronounced on the algo HFT charts than it does here. So looking at this here, now you can see. See that? Right there. That was done on huge volume. At that time, it was huge volume. This is the granddaddy of huge volume. There was a lot of buying going on there, a lot of shorts getting squeezed and burned. It's like those old cowboy movies where they're burning down, like, you know, things. It's town, the bad guys come in. And this was really a short inferno on Friday in between new buyers. Seriously, look at the volume. Right? That beats anything that I've seen here. I mean, here was one big buy volume, but that was just that was somebody setting up a trade at 4 p.m. because they know they would go higher a little bit. They do it all the time. But there was no indication whatsoever here because there was actually a sell volume at 345 of 184,000 shares. You can see that on this side, right? So there was no way of telling. And then at 4:01, I mean, that at 4 p.m., somebody, you know, some programs bought 141,000 shares with no movement on the prices. That's how the algos dominated. With a volume size this big of 135,000 shares, guys, don't you think that we could actually see a spike No, we don't. We just see a blip of a green candle. And the way they do it is I don't exactly know how they do it, but I do know that the way they do it is they keep on short. You do this complex thing here where they're buying. Okay, a certain firm is buying a lot, but they're suppressing the price by selling on some other exchange or something like that. But in the meantime, the net accumulation is 135,000 shares. You got it? And
There was a spike down on the momentum indicator at the bottom.
yeah, and there was a spike down on the momentum indicator. That's because that's because of this stupid bum trade of whoever did of maybe one share. You see that?
Okay.
That's tape reading. You're right. It's like a lot of the times you see Priceline, a lot of these big stocks, 10 shares is down $10. Like, remember, a market maker, and in these cases electronic market makers, will simply bid and ask based on whatever the volume is out there. So you should try this. You should throw a stock out there after hours, like sell one share, and I bet you they'll drop the price $4. Yeah, because there's no market. When there's no market, they'll just go with whoever is bidding or offering the stock. You got it? So this little blip here you're looking at right there, this one, is the one that caused this, and you can't even see it on the volume because it's so small. So that's why a lot of people call it bad prints and stuff. They're not bad prints. These are algos playing around to test the water. They want to test the water by sending two shares, and I've posted many articles on this stuff. They'll send, it's called spoofing. They'll send out 10 shares just to see if there's a big whale out there who gets scared and sells 5,000 shares right on the block. And maybe the algos are short, and they'll basically cover on that. And that this happens a lot, and it happens so fast you guys don't even realize. I don't even realize, and that's the reason why Goldman on that fateful morning on Thursday dipped so hard. It was down $3.50. If you do the 5-minute chart, you can see that here. This one was blood red till it turned. And that's why the algo charts are so important, because they showed the movement very quickly. And I'm like, that's it. So that was the lotto ticket that was alerted at 40, 50, 60 cents that went to wherever it went to, I think $8, $9. So that's, imagine that. Just by identifying one major reversal candle, which happened, by the way, on heavy volume. Look, that volume wasn't a joke. That's 186,000 shares of Goldman Sachs that were covered, bought, and shorts chased out of Dodge. But was it a straight line up? No. For the rest of the day, they did nothing but confuse the crap out of non-tape readers and just price lookers. And that's what they did. You understand, guys? So these things are very important for active traders. And on the days, let's get some time and you're actively trading and stuff, to me, it's just like I'm watching these things. I mean, I see stuff like this happen a lot. So it gives me a little insight into the movements, aside from just looking at the technicals and looking at that. I look at price and volume quite a bit, especially on a shorter time frame, to identify what's going on, especially with the Goldman Sachs type of the world. So saying all that, let's take a look at a 1-hour view. The 1-hour view is saying 248. Definitely play it. Small things are cheap. If they pull back, remember, this is a very clean chart. Very clean chart. If we break below 230, I mean, at this point it's 242. So if we break below, let's say here, let's look at the shorter term view. There's a gap here. See that gap?
Yes.
I'm drawing it out. That's a gap. When the stock opened up on Monday and said we want to kill everybody and the market collapsed there. That's your gap. So basically, from a technical level, you break 237, there's a chance that it comes and fills this gap. 230, I highly doubt it, given this type of volume structure. There was one sell program. That's when I said let's short Goldman, which was a losing trade. you know, on the lottos. So it didn't really matter, but still, it was a lotto. So there was only one, and that was at 1 p.m. right there. See that? So that means there's some heavy-duty stuff going on. There were no committed sellers on the stock, regardless of the fact that it was overbought, blah, 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 blah. Doesn't matter. And so at this point, if we're 237, breaks 237, there's a chance it comes and tests the upper end of this gap, which is 234. I'll be alerting, but at the same time, keep that in mind. In the meantime, a minor pullback or maybe $1 or so means nothing. The bull flag, it's actually a channel. Lower end of the channel is around 240, to be honest with you. Actually more like, yeah, 240. So it can do that. Whichever the case, the next 6 points on the stock or so, try to take it. It's very profitable. Swing, we'll go with that. Now, news just broke, which I just posted out there, which could be very positive for overall banks. Okay, and the Twitter feed. It's read it when you can. It says I put the word Brexit delay, which I kind of suspected might happen. Theresa May's Brexit plan under pressure ahead of parliamentary test. The Brexit thing on Friday, 2 p.m. Wednesday, 2 p.m. The Fed thing, right, with which came out, was the first of the votes, which overwhelmingly passed, which it should. You know, they voted for Brexit. They're doing Brexit. Question is, the trick is, what are the conditions that are going to be, time conditions that are going to be put there? This is what the market, this is what you guys should know this. The markets don't want a hard Brexit. They don't want tomorrow morning Theresa May to walk in and say, see you later, I'm out of it. Okay? It's not a political thing. This is an economic function. Okay? An economic function. And the point is that from a timeline standpoint, a slight Brexit delay, what we call a soft delay or a softer Brexit, not a thump like we're out, we got to negotiate every single trade agreement. It's not a joke. When you get into the nitty-gritty of it, of trade agreements, it's not like, hey, buddy, how you doing? I'm going to sell you a BMW. Yeah, okay, you know, I'll sell you a couple of Boeings. No, it doesn't work like that. There are layers and layers of what do you call, agreements that you have to go through before you do that. So it's not a joke when a country, a major country, does a trade agreement, renegotiation, whatever, with another one. Just talking about the, you know, not the politics, the mechanics of it. So the fact that this particular article, from what it says, one of our own parliamentary members from the Conservative Party supposedly has basically now said, I'm not going to vote for immediate Brexit. Brexit's going to happen. It's done. It's in the paper. But a slight delay, a soft Brexit, would be the most beneficial for a lot of multinational banks and many, many banks which have global operations to rearrange their operations and have the right plans instead of them doing a hard Brexit. That's why somebody asked me in the chat the other day, is it good or bad? I said a slight delay would be great. And that seems to be the case right now. Okay, so this could be very positive for overall financials, especially global financials, and good for overall, you know, good for the overall international banking system. All right, and so that could be a catalyst. Just letting you guys know that. That could be a major catalyst. The other thing that I put out there, I'm going to actually put out there right now, is the fact that the dollar has been, is now, the headwind of the stronger dollar is now starting to abate in a big way. In a big way. The CEOs of all the multinationals, they love the fact that Steve Mnuchin and Trump himself have talked about that a lower dollar would be good for us, which is exactly the, you know, which is true. So the point is that the DX, which we're going to look at right now, should have a very positive headwind for the first quarter of 2017 from the profit level. After all, on that same article, you'll read that the overall profit growth was supposed to be like, what did I read? 4% or something like that. It's running at right now with all the companies that are reported, the average profit growth is showing an increase of 8%. That's pretty damn good. Let's take a look at the dollar. So there are two major headwinds which have now eased. Stronger dollar, take it easy, calm down a bit. Eventually it'll bounce again. If Europe doesn't pick up the steam and all that stuff, the dollar will bounce again. Dollar is always king, you know. And but that and the profit numbers coming out of the SPX, S&P 500 companies is beating consensus estimates by almost 200 basis points. Quick look at the chart. This is not a chart I want to buy necessarily unless I want to do some real technical trading. I mean, looking at it from a daily standpoint, let's look at it from a weekly standpoint. No good. You know? So basically the dollar is weakening. Dollar never crashes. It's weakening. Okay? And remove all drawings. So looking at this here, and without getting too particular about it, I'm looking at about 97. That was the big breakout, right? That was a big breakout here. That support. This is major support, 92. I mean, if it goes to 92, come on. The markets are actually going to start getting scared. They're like, what the heck's going on? Why is the dollar crashing, crashing 8%? It should go down there, but it should do it on a more staggered basis. I remember what I always say. It's not where you're going to go, but how fast it's getting there is what unnerves markets, whether it be rates, whether it be the dollar or anything else. Some people might say, hey, listen, this could be just simply a retest of the breakout line. Well, it's no longer a retest, it's a breakdown. Some people will say, hey, dollar bulls will say it's a cup, it's just creating a handle. So okay, that's fine. So that handle could also come down to about 98. Whichever the case, if you look here, for the last 1, 2, 3, 4, 5, 6, 7, that's seven bars, is it?
C6.
6.
Six
So
red bars.
Okay, 6 red. So 6 weeks, the dollar has done nothing but sold. And it's really as simple as that. For 6 weeks here, the dollar has done nothing but sold. And I'm looking back here to 2014, since the breakout of the dollar, almighty dollar, from the 80 level. Okay, since 2014, the dollar has had 1, 2, 3, 4, 5. This was a 5-day stretch of a fall. So whichever the case, it's getting thumped here and on heavy volume. See that? Because the global markets know that the new administration is going to use their bully pulpit to talk down the dollar. That's it. And then, of course, there's stuff going on. Maybe the federal central banks are selling dollars and to prop up their own currency, all kinds of stuff. So, okay. And this is good. We know a weaker dollar is not just great for U.S. multinationals. Who else is it great for, and why is that so important to us?
Weaker dollar is better for the exporters.
Well, that's what I said. For multinationals, it's fantastic. And they've already started talking about it. Who else is it really good for, which really helps global financial markets? I've kind of given you guys a hint.
You talk about banks?
I've given you a hint. The word global is the hint. It's very good for global emerging markets, because emerging markets, if you recall from my previous videocasts and stuff, basically are heavily indebted in US dollars, because when they go borrow in global financial markets, they borrow in US dollars. They're not borrowing in yen. So yeah, they borrow in yen too as time. They're not borrowing on the renminbi or the won. They're borrowing in dollars, the British pound, the German mark, and the Japanese yen, but primarily the dollar. So when the dollar is screaming higher, what is it doing for EM, which is the emerging market debt? Debt servicing goes nuts, right? A strong dollar makes them like it's a serious situation. When EMs, they got to pay back the interest in dollars. And with dollar that's strong, dollar strength, they got to devalue their own currency in order, because when the dollar goes stronger, what happens to emerging market currencies? they go weaker. Okay? They go weaker. They go the other way. So now they have a weaker currency. They got to go buy a strong dollar. They get screwed. That's why emerging markets do not like a runaway strong dollar. That's the reason why emerging markets over the past couple of weeks or so have started to emerge higher. And that is good for everybody, because that allows them to continue with their export operations, their importing American goods and stuff like that. Do you guys understand that part? So a weaker,
Yes.
yeah, the weaker dollar is not just benefiting our multinationals. It's also benefiting the fact that their currencies are getting stronger. They can buy more from us, and they can service their debt, which emerging market debt is pretty substantial, which is priced in US dollars. So that pressure, they can go to bed at night knowing that they don't have to pay a higher dollar amount for the same amount of debt that they borrowed. Got it?
Mhm.
Jim?
Yeah.
Good.
Got it.
Yeah, some simple stuff. So, one second. One second. Okay, now, any other quick questions? What stock do you want to look at? We got Priceline coming up. We got Priceline coming up for earnings soon. What comes to mind, Jim? Let
I don't know.
Okay, I'm going to fill you up. Yeah, I'll just do it quickly. Let's take a look at our favorite, the Swing 533. Real quick. We're going to keep this simple. Fantastic. Just fantastic. Look what's going on.
Yeah.
Yeah? This is the point of like where you start getting that big euphoric move. You know, it lasts for a couple of days, which I say by this week. Don't short Labor Day weekend. This is also showing that. That's when it starts to drip. This is the most powerful indicator. We have a crossover. That crossover wasn't there, even though the markets were slightly going higher. The stochastics were still going down. Once you have a crossover, you sit tight with your swing trades. Jim knows that. You know that, Tom, right? So we're good. Again, here we are looking to go positive on the histograms. Once you get 2 or 3 bars, given the state of the markets right now, don't overstay your welcome in the bull house, in the bull camp. All right, 2 or 3 bars positive. This will be up here at the 90s. Markets won't be like, oh, it's so strong, this and that. All of a sudden, it'll do this. All of a sudden, you'll get a quick reset, which none of us want to be on the other tail of it. So once you see this shaded area stay in the 90s for a couple of days, could be a day, could be a 2, but once you see this line continuing, you want to stay with swing trade. So this is good. This thing like told me like, okay, I'm gonna buy those S&P calls. I'm gonna sit on it. Now, let's take a look at the other one, which is really important, which is the NIMO. That should give us a nice picture. One second. Let's do this up. Give me 1 second. Price labels. And we are done. Just put a little splash of paint. There you go. Okay. So quick couple of things happening here real fast. This is definitely positive. We are now over the 50 moving average. That's the blue line right here. Over the 50 average. That's why I put the 50 average on the spike on the McClellan oscillator. Upper end of the Bollinger is 33. That's where we're going. That's what will bring us back into the low 2310 level. Okay. It's very positive that we touched the lower end of the Bollinger, so we weren't in limbo. It satisfied that point. We are above pivot. Pivot's at 4.94. Can you guys see that?
Yes.
Right there? That's pivot. Okay. So we are above pivot. looking at pure technicals, which is positive. That's a jump higher. This is starting to turn, which is very interesting because I haven't seen that really go into positive for a while now, since the end of December. If these histograms go positive, we're going to basically go to 33. I mean, we're going to 33. We're going to go to 2400 very, very, very fast, or that 2340 level or wherever I talked about. That's only if these histograms go positive, like it did here back in November. We have just started to do that. This fast stochastics is getting overbought, and so we'll have to keep an eye on that. But at the same time, one last thing I'll show you guys is I will switch that fast stochastics to a full stochastics and see what's going on. Great. Exactly what I wanted to see. And this is the first time I'm seeing the full stochastics, by the way, here with you guys. And so the full stochastics is telling us we just started the move up again. See that? Right there. And we have a crossover here. So this is a good sign that we're going higher. That's really what it comes down to. We will get volatility unless some big bad event that I'll certainly be alerting and sort of translating to you guys out there happens. We still have that little, we have a bunch of 100, 200 points to move from here. Let's stick to that. and that pretty much, explains the whole picture as we stand right now. Was this helpful to you guys today? Because we covered quite a few things. Yes. Okay. Jim, you're good? You're good?
Always helpful. It's great.
Very good. When are you driving back?
Probably, I have a ferry tomorrow night, so I'll be here tomorrow, and then I'll be back to work on Tuesday.
Okay. Give our love to everyone. And Tom, you feel better, and I'll be in touch with you guys. All right. Thank you.
Thanks, guys.
Okay. You too. Bye bye.